Welcome back to another episode of an Investor's Journey podcast. I'm your host, Jonathan BRRRR, and we are finally joined by the hairier half of Prime Homes, Mr. John Barr.
Hairier half, really? I guess that's true.
It is.
Yeah, no, it is.
This episode, the reason John is joining us is he wanted to be on video. No, but the real reason is that we just did a property. We used the BRRRR strategy and everything, but it was a little bit more unique. And we reached out to a lot of investors that own rental properties, and they could not really help us with this process. So essentially, in a nutshell, we purchased a property subject to, borrowed a second lien for renovations and everything. Third lien. Well, we'll cover that, the third lien. And then it was pretty much our question was, can you refinance everything together? So nobody could give us a real clear answer on that. So I figured, being that we went through it successfully, to put it out there and kind of just go over the whole process. So,
well, to add on that, because you can always refinance out. Well, the thing we were trying to do is if you buy a property and are paying off an underlying loan, banks will lend you up to 80% to do a refinance. And that's what we were having. We didn't want to get stuck with having to wait for it 6 months to be able to lend up to the 80% of the appraised value. Otherwise, banks will, if it's your own money, will only lend you 80% of your purchase price in that first 6 months. We obviously wanted to do this much faster to turn money a lot quicker. So that was our question, is taking it subject to the way we did it and then borrowing money for our rehabs to leverage it up to the 80%. Would we be able to refinance all of that out in less than 6 months to get to that 80% appraised value mark versus the 80% of the purchase price? Because that would have been a huge problem if we could have only been allowed to do that.
correct. So, funny story of how we actually got this lead. I was texting who I thought was a wholesaler because they have the same names. So I sent a text out. I was like, hey, do you have any deals right now that you're looking to wholesale? And they actually responded, and they're like, yeah, I have 2 deals right now. They sent both of them. They look, one was pretty bad, and then this one was very marginal. And we kind of started going back and forth looking at it, and we ran the numbers with John as a rental. That's how it made more sense. And all this while I'm still thinking I'm dealing with the other wholesaler. And then finally, after a while, we actually got on the phone to talk about it, and his voice was weird to me. I was like, what the hell's wrong with your voice? And then I put it all together. I was like, oh, so you're not the person I thought you were. So it was just like a real happy coincidence, because I would have never really reached out to this person otherwise, because in my mind, they don't wholesale properties. They invest, they do owner finance, they do a lot of other deals. So I would have never reached out to him if I didn't accidentally reach out to him thinking I was reaching out to a wholesaler.
Just goes to show, where do you get deals?
Anywhere.
Anywhere, everywhere, randomly, not randomly, just you never know.
Just got to be in the business. So this deal, they had it on the contract subject to already.
They had already owned it.
Right. They bought it subject to.
They bought it subject to.
Because that's their whole strategy is owner finance and stuff like that. So that's kind of, I think, the route they wanted to go on this one. But the numbers were too tight, and the house needed more work than they were willing to do on it. So we looked at it, we really try to run our numbers on this because it was tight. And one of the biggest hesitations that we had, it was that it was on a very busy road. So that road and everything and the numbers kind of tight, it made us a little hesitant. But what we like is that price point that this house is in. So the price point of this house is between the 165 and 175 price point, which is great for appreciation. It is great for rentals. It's located on the northwest side. So, all of those things was the thing that really set us over on buying it, because it was like, there's a lot more potential upside to this property. So we went ahead, talk about so we assumed the no.
Yeah, basically what we did was, as they had already bought it subject to several months prior, like John mentioned, numbers weren't going to work out for them, so they were wanting to essentially, well, when we approached them, we were going to buy it from them. And they said, hey, if you want to go ahead and take it subject to again, go right ahead, or pay it out in cash, go ahead. So when we really started looking at these numbers, what really made it nice is that they had already reinstated the loan, so it was current, and the principal value was right around $93,000. But the interest rate was only about 4.25%. So when we borrow our money, we pay a much higher interest rate on what it is. This loan just happened to be 10%. So we could essentially save us the interest payment spread between $93,000 at 4.25% and $93,000 at 10%. So that's why we really started pursuing the subject to route, is because we could see that we were able to keep a pretty decent spread on that amount of interest rate, considering we were going to have to hold this thing for a month and a half, 2 months while we were going through the renovations and the appraisal. So once we really started digging into it and looking at it, they took it subject to a little differently than what we normally would. But I asked them if they still had contact and good relations with the previous seller, and they did. So we were able to work with that previous seller. So we were buying it subject to from the new owners, but still getting documents signed by the previous seller, who was the owner of the original note, if that kind of makes sense when it looks at from a bank perspective. So
Yeah.
is that what you're really kind of...
Yeah. But there was something else with the escrow. So the reason why we wanted to do it subject to.
Another reason why I want to do it subject to, if we would have just paid the thing out cash, say if we would have borrowed the $110,000, if you call it, to buy the property out, there is an amount in escrow. So when they reinstated the loan, the bank wants all the escrow money reimbursed. So there was about $1,400 sitting in that escrow account by the time we were going to refinance. To where if we would have just paid it off, the title company would have paid the bank, and then that escrow refunds would have been sent back to the original owner of the property, who was not the one who put up all the money to reinstate the loan, and not the one who was buying the lot or the house at that time. So we wanted to take a crack at trying to get those escrow funds, because technically they were ours, because we were paying out the wholesaler, reimbursing him for all of his costs, and letting him make some profit. So that escrow account was essentially our refunding that we had done to the bank account. So we wanted to capture that escrow, but if we'd have paid cash, we would have had no chance at it. But this way we did have a chance at capturing that escrow account and the insurance refunds that come back after we sold the property. So that's another reason we wanted to take a sub 2, is we're going to save money on the interest, and there's a chance that we might get a kicker from the insurance and escrow reimbursements. So that was another big reason why we wanted to take that.
And how did you make sure that escrow check was coming to us?
So once we bought the property, and the previous people we bought the house from never did this, so that's why I knew they wouldn't have got the check either, is when we buy a house, in the documents, we have power of attorneys that say every right to that escrow account, that money is ours. It's in the deeds, it's in the power of attorneys, in the closing documents, that money is ours. But the bank is not going to issue a check to us. They're going to issue it to the person that is on the note and deed of trust that signed the loan documents. So when that check comes, it's going to be in that previous person's name, but they're going to mail it to whatever address that they have. So with the power of attorney that we were given at closing, we went ahead and got authorization onto the bank account and changed the mailing address to our mailing address, where since we were the one making all the payments on the mortgage going forward. So that's one way how we made sure that check came back to us. So that's one thing that they always say, is make sure you change that mailing address, because even though the seller knows that money's yours, if they get a check in the mail that's addressed to them, to their current location, their house, they're going to go cash it. You're never going to see that money again, even though it was yours, and it's not going to be worth trying to fight to go get that amount on a smaller house like we deal with. Maybe if you're talking tens of thousands of dollars in escrow account, but this one was only a couple thousand.
And like we said, even though that money belongs to you, when John took the check to the lady, I mean, was she happy to endorse that?
She still wasn't happy, even though we had explained to her a number of different times of why. All she saw was, well, I've been paying that escrow account. Well, yeah, but last time you made a payment at the escrow account was 13 months ago. So whatever money you had put into the property is no longer there, because you've burned the insurance and we've reimbursed you all the taxes payments and made all your payments going forward. So that's why, but it's a very kind of complex scenario that if you're not in real estate, familiar with these transactions, you're not going to get it. and she was having just a very hard time understanding why that wasn't hers. But at the end of the day, when she finally was like, okay, well, I guess that makes sense, sign and endorse the check, because even though we have all the authorizations, banks are still not going to they're probably not going to let you power of attorney to endorse the check to yourself. So they want to kind of do a CYA cover your ass kind of ordeal and be like, well, we want you to have, even though it looks like good on paper, we want them to come in to endorse that check. So that we still needed her to sign the check over to us.
Now, a lot of people, every time we talk to people, they always think that, well, it's not worth the headache. But when you start doing so many transactions and you start doing so many deals, thinking that way is going to end up costing you thousands and tens of thousands of dollars throughout the year. I mean, this alone, it was like $1,400 in escrow. And then just on the savings of taking it over subject to, I think we had said it was around $900 that we saved on interest payments.
Basically, the spread was between the interest payment, just the $93,000 at 10%, and what we would have paid in $93,000 at the 4.25. It was $445 a month savings on the interest. Times that by 2 months, we're talking almost $900 in savings just in interest payments alone. And then we did manage to get at least the escrow check back. The insurance doesn't look like we're going to get that one back, but we knew that was a risk going in, but it was a chance that we might get those back, which was going to be great. Regardless, we would have saved $900 in interest, but this way we were able to get an extra $2,300 back onto our bottom line in the deal because we got the escrow refund and that interest savings on the whole transaction.
And that's an extra $2,300 on just this one transaction by doing things a little bit different, right? Not just by looking at the easiest, fastest solution. It's just trying to think through it and trying to understand all the pieces to the puzzle. Because again, that's just one deal. You do 8, 9, 10, 15 deals a year. You're talking about that's a lot of money. You're talking about $20,000 that you could potentially have in savings, and that's money in your pocket. So now we closed it. We borrowed money, right? So we borrowed what would be the third lien. Should we explain it now or at the refinance part, the 3 liens?
I can do it at the end.
All right. So we borrowed a third lien position. Pretty much was our financing. Repairs. So that covered the reinstatement, that covered the repairs, that covered holding costs, and we borrowed more than we needed because what we always like to be at is at that 80% of what we believe the ARV is, because we want to make sure that we can refinance up to the 80%. The majority.
If you don't borrow enough, they won't let you. If it'll become a cash out refi at that point, right, which then they're going to want you to hold it 6 months. So whatever they're paying off, that's what the only amount they're going to lend against, but they'll lend up to 80%. So if you only borrow 75 and appraisal comes in high, they're not going to let you borrow that extra 5%. So that's why you run a really good job of what you think the ARV is and borrow 80% of that, even if you don't need it. It's something it's extra money that you can have that you can use towards your prepaids and your closing costs when you do your refinance.
So why, actually going back a little bit, why did we decide to go ahead and do it? Because we started doing the research. We started calling investors that have rental properties, 10, 15, 20 rental properties. They've done this in the past, and they couldn't tell us if you can refinance a subject to with other liens and everything together.
It all said, it's like, well, yeah, in theory, yeah, it seems like it should work just fine. I don't see why not. But we couldn't find somebody that said, yes, I've done it. This is going to work. So it's like we looked at it from that standpoint. It's like, do we go after a $2,300 savings, or do we just say, nah, screw it, we're just going to go at it the black and white previous way we always do it?
And pretty much the deciding factor was we knew that if for whatever reason the refinance didn't come through, we knew we could put it on the market, essentially flip the deal. It wasn't going to be a big money maker at all, but we would have been out of it, right? Yep. So it was, in that scenario, it was worth the risk. It was worth just taking this down, doing what we do, renovating it, and then seeing like because if it qualifies, great. We have an awesome rental in an area that we want to have. If it doesn't, all right, we'll put it on the market. We know we'll get our money back and then some. It's not going to be a huge windfall, but we're protected. So all in all, it made sense when you weigh. Well, that's what we do with all our deals. We always weigh like, what's the worst case scenario, and do we walk away from that? And if we walk away from that, we go ahead and do it, especially when it's a learning process. Because again, we spoke to a lot of investors and they didn't know how to do this. They didn't know if it could be done. So we're like, okay, cool. Let's, we have a chance to do it with no risk.
So what we really ultimately do, because it's your lender that's going to be the ultimate deciding factor. So when we called the ultimate refinance lender, who's going to refinance it into a 30-year fixed rate loan, we called and talked to them and explained to them the situation. And said, as long as they're paying off promissory notes and deeds of trust, your name for the refinance, and it's not money against yourself, he's like, yeah, that should be no problem. So we decided to, well, let's go ahead and try it and do it and see what happens.
Yeah. So, all right. So then we borrowed the money and we started with the renovation. It's basic renovation that we do to every house.
It has a $25,000 rehab of just gutting the kitchen, repainting the thing, putting new flooring, putting new kitchens, redoing the tubs in the bathrooms, updating those, putting some very durable flooring in, and getting it to where it's like, hey, no matter what appreciation comes in the next 10, 15, 20 years, you're probably going to catch it because now everything is updated, and that's really kind of the life cycle of those kind of products.
And the flooring that we use, that's good flooring.
It's just a vinyl stick down that looks like wood laminate stuff. Looks great, and it's got like a 50-year warranty on it, and it's 100% waterproof. I mean, a tenant could drop like a hot coal on it, burn a hole in it, and all you got to do is pick up one piece and put that one piece back down. Versus laminate, if you damage it, you got to pull up from the corner all the way to the edge and then come all the way back. And so now instead of doing hundreds of pieces, you're doing one piece. So that makes it pretty easy.
Yeah, and we do that on all the rental properties just because it does look good. People walk in and they're like, man, this is laminate floors. I love it. It's wood floors, right? And it's not. It's a vinyl stick down and it's extremely durable. I mean, it really takes a lot to do any damage to that.
Well, I don't understand this, like why anybody even bothers to put carpet in properties, because I mean, as a landlord, I would hate having carpet because no matter what, every 2 years, two tenants that move in and out, you're gonna have to replace the carpet. It's nasty, it holds germs, it doesn't clean very well. Tenant hate it because of that exact problem, that it doesn't clean up, it's hard to mess with. And the last couple properties, like everyone's like, I'm just glad there's no carpet in here. Because no matter what, you're replacing every couple of years, and then you either need to eat that cost or try to get money from a security deposit from stains on a carpet, which then your tenants are even pissed about that. So it's like, I just put laminate through the whole house and call it good.
And it limits your risk. Like, we rent to anybody that has, even if they have pets, right? Because if you start discriminating against people that have pets, you're discriminating against a lot of potential tenants. And if you have carpeting in the bedrooms, now you're running a risk that as soon as those tenants move out, you're going to have to replace it. You might not even have a chance to keep it for another tenant because maybe the pets destroyed that carpeting. And even though you have a security deposit, it may not cover all the labor and materials of replacing that carpet. But with this floor, it's like they're really not going to screw it up. I mean, it's very hard for them to damage this floor. They can move out, we clean it, touch up paint, and it's ready for the next tenant. Even if we want to sell, I mean, we just touch it up, put it on the market, and it's good to go. Because it's still modern looking, it still looks updated, so it just works. That's why I wanted to make a point of those floors, because it's a really great strategy to use. They look awesome, and we run them through the bathroom, kitchen, I mean, everywhere. We run it through the whole house. So very, very good thing to use. All right, so we renovated it. We didn't have any problems with the renovation. Everything worked out fine. Yeah. Now the refinance process. So what was the slowdown here on the refi?
Number of different things.
I feel like a reporter. So tell me, John, what was the slowdown on this?
Well, I mean, just refinancing anything right now is just a pain in the ass. Just like appraisers are backed up. There's not enough people here. You look, any new number of different causes of what causes it. But one, the appraiser just took forever to get called out to the property. I think it took us like 5 or 6 weeks, even though we started pretty much immediately on the refi. I mean, we were done with the property and just waiting for the appraiser to come out there, and it just took forever. So that was the main thing. And I mean, I think the appraiser, we paid like $600, and it's kind of always funny every time I talk to an old boy that's been in this for a while. It's like, man, I remember back in the day that appraisers were only $250 in the early 2000s because there was a bunch of them. But after the Dodd-Frank reform and everything, it's just prices have just absolutely skyrocketed with the amount of people here, and the qualifications to become an appraiser are just not impossible, but they just take a lot to get that license.
And we also had a rude awakening with the appraisal, right?
Oh yeah, and that was nothing with the appraiser. Is we were factoring that we were going to get a value of like 170, 175, but the appraiser actually came back at 165. You might say to yourself, like, well, $5,000's not that big a difference. Well, it is when they'll lend up to 80%. So we actually had to put more cash into the deal than anticipated at the very end to get the refinance down. So it's not that big of an issue, but it is still an issue if you're working on an extremely tight budget. We had a little room to make this whole thing still work, but it did appraise at the 165, and we had to put a little more cash down to do the refinance. So that was a little bit of a
and I mean
awakening.
That's the shit with appraisers that we always talk about. We ran the comps still, and we're like, man, it's crap that they appraised it that low and everything. Like, you could definitely make a case for 170. And that was one thing, I think it was on this one, right, that we learned about shit. No, I'm thinking, I was like, should we say it? But what we did with Cliffside of selling it and doing that. No.
You just don't mess with that stuff. It just takes too long. And is it a gray area? Is it right or wrong? Who knows? Nah.
But it appraised. So it appraised at Cliffside.
Yeah.
But all right, maybe we'll cover that at a later point. But yeah, the appraisal didn't come back exactly where we wanted it. Like John said, we had to put a little more just to bring it to that 80%. So it made sense. But all in all, it came out. But what was the problem also with title?
Well, the title
and the 3 notes.
We were using, a couple of things.
Liens.
One, when you're doing these investor kind of transactions, you got to understand that you are the expert in the scenario. This is not going to be your bread and butter transaction that if, like, hey, I'm going to sell my house to John, he's going to get a conventional loan. He's a traditional buyer. I'm a traditional seller. Title companies see that all day. They'll breeze right through that kind of stuff. But when we got a transaction like this, it confuses them because they're not used to this type of transaction. So when the lender company we're refinancing with, done multiple refinances and purchases with them, so we know them. But they've never found like a really good title company that they like to use, and this came by recommendation to them. And their communication kind of sucked. They're one that they had multiple people on an email with like a team of people on it. So then numerous people were kind of going back and forth asking for new payoffs and new documents. But one thing that really confused them is that we technically had 3 liens on the property, but only 2 of them were getting paid off. They were having a hard time grasping the type of transaction because it was subject to why there was so many liens and we're only paying 2 off. So the way we borrow subject to is the bank lends the money to the buyer. So there's going to be 1 lien there. When we buy the house, we essentially create a promissory note and deed of trust from the seller to us. So there's a 2nd lien right there. Even though that lien is the exact same amortization schedule as the 1st lien that was from the bank. So essentially it's a wash. So we would technically pay them, they'd pay the bank, and the middle person make no money because we bought the property from them. But what that instrument does is allows them, if something happens to us or we default on their loan, they have an instrument in place to foreclose onto us because this is damaging their credit still. That loan is still against their credit, and if we didn't pay, their credit's the one that's suffering, not ours. So it gives them the ability to foreclose on us, to get the property back, to fix it up, and go to sell it. To where if somebody gets put in front of a judge and they're saying, oh, they damaged my credit or trying to blame you, when you go back and say, hey, I gave them every right to foreclose, here's the instruments to do it, I think that's going to look a lot better than just saying, yeah, I quit paying and I didn't want to give them the house back, so I forced them into foreclosure and they had no way out. Since we're the subject matter experts, I'm going to give them that kind of documentation to do it. So that's why there was a 2nd lien, and then we borrowed the money to bring us up to that 80% for repairs, which essentially created a 3rd lien. And it confused the title company because we were essentially paying off the 1st lien and the 3rd lien. And they didn't quite get that the 2nd lien was automatically tied to and going to be paid off once you paid that first lien off. And because of all the people attached to the email And the lender and them not understanding it, there's a bunch of back and forth of like what was going on. They couldn't understand why. And eventually I just had to intervene and say, look at the deed of trust, look at the note, and it references the first lien, and it says right here in black and white that this note expires upon the time of paying off the first lien. So eventually they got their heads around it and understood the type of transaction, and were able to do the full refinance for a conventional or Fannie Mae backed loan.
Got it?
Good.
So essentially, I mean, just to maybe simplify or dumb it down a little bit, the bank lends to the buyer, which is now the seller, right? That's one lien. Then we create a second lien between the seller and us. That's two liens. And then there's a third lien between us and our money lender for the repairs and all that, which makes it three liens. And title didn't understand that when we pay off our seller's lien, it automatically pays off the first lien. So they didn't understand why we were paying off two instead of the three. But
is there an echo in here?
There is.
I feel like you just said exactly what I
It
just
sounds
said.
better.
Does it?
Oh,
it's because you have no hair. It makes your voice better.
It comes off smoother. But so real quick though, because you said something that was interesting, that we give the seller a chance to be able to foreclose on us. So not many people are doing that, or some people don't do that.
Some
right?
people don't, whether they just don't want to mess with it. And it all comes down to is it costs money to have an attorney draft those documents, or to protect yourself correctly for you and the person you're buying the house from. And that was something that was a little different that the first person we bought it from. There's nothing to say that's wrong. There's no law that says you have to do it. It's just something as assurance that I think it's more an ethical, right thing to do. And it looks better from that scenario. I said if I ever got called in front of a judge and had to explain the transaction, I'd rather have that they're saying we gave them the instruments to do this versus, yeah, they're screwed. Because that's one thing that almost blew up the subject to type of transaction is a lot of guys out like South and West Coast in Texas or borrowing a bunch of money from a bunch of people, or not borrowing money, but buying houses, not giving a promissory deeds of trust, borrowing more money against it, renting out the properties, taking all the cash flow and not paying the underlying liens. And they took a whole bunch of people back into foreclosure because the banks were not foreclosing for anywhere for 6 months to 2 years. And they were the ones keeping all that cash flow and not paying off the liens. And those people had no way to foreclose because they never gave it to them. So that was something that caused a lot of problems. So anytime we buy it, we make sure, hey, you do have these documents with you that if something were to happen to us, you can get the property back.
Right. And that's the thing I stress in a lot of podcasts, as you guys have heard, is that if you know better, do better, right? I mean, just because you can get away with it doesn't mean you should. This is the reason why all these laws get created, why right now they're trying to get rid of wholesalers. They're trying to create laws where you need a license. You know, you need to be a real estate agent or whatever it is to get rid of all, because people are just taking advantage of people just because the other person doesn't know better. And I hear this from wholesalers, investors, and flippers that they're like, well, you know, it's on them. They didn't know any better. No, it's on you. If you know better, do better. You understand? And that's the thing that we always look at. It's like, it's going to cost a little more money or whatever, but it's the right way to do it. You know, and that's with anything, whether you're borrowing money, whether you're doing whatever you're doing. If you know there's a better way to do it that protects both parties, do it the right way. You understand? Set an example for future investors and for other investors. So that was definitely important. All right. So all said and done, what I have is PITI pretty much came out to about $1,080 at a 5% interest.
5.125 makes a big difference.
Yes, 5.125% interest. When we rented it for $1,400. How long did it take to rent?
It took a little longer to rent, than our previous properties, but I mean it was still way less than a month. I want to say it took maybe 2 weeks to get a rent. I think that was just attributed to the busy road that it was on. But eventually rented it out to a nice engaged couple with I think it was 2 cats and a dog, or 2 dogs and a cat, or something like that. But yeah, I mean they loved the house. They loved the fact that it was renovated, updated, and had no carpet once again in the property. And they wanted to stay in the area because their landlord of the house they currently lived in was selling his house.
Yep.
Or selling that house.
So all in all, it worked out. You are able to refinance subject twos with other liens and everything, and bundle pretty much all the liens together and refinance them out. At least we were on this one. It's something that, again, communication is what I tell a lot of people when they send the contracts off. They're like, all right, title will handle it or whatever. It's no, you need to stay involved. You need to stay involved in the communication, like John was, that he was paying attention to the emails and was seeing that way too many people involved. A lot of things was getting lost in translation, and it was going to screw up the deal, right? So you got to step in. You got to pay attention to it. Don't just depend on the title company. And this doesn't mean that the title company is garbage or anything. It's just there's too many moving parts, and this is your deal. You're the one that needs to care about this, not your title company. Yep. So this is why we do these podcasts and why we do all this, is to kind of share with you our learning process, our journey, right? And doing all of this, all the things that we're learning, all the things that we're seeing, as we do business with people and as we do different types of deals. So this one worked out very nicely. We're sitting in a really nice area, good cash flow, great tenants, property's good to go. So we definitely plan to keep this one for at least the foreseeable future.
Yeah, and I mean, I think we're in it for 135. It appraised at 165. I think we make a strong case for 170, maybe 175, and we're getting roughly about $310 a month in cash flow. So works out pretty well.
Yeah. So all in all, good deal. I want to thank John for joining us on this one. He's very busy, got a lot of properties going on right now, a lot of running around. So
I drive. I don't run everywhere.
Well, now you started to drive. All right. So if you have any questions, anything that wasn't clear, because John talks a mile a minute, comment below, shoot me an email, let us know. We're here to help you guys out. Any questions you have, anything you need further clarification on, we're here to help out. So I hope you guys enjoyed it. If you know any landlords or any people that, are buying a lot of rentals, share this with them. Make sure they know, that this is a possibility, because it, like I said, we were able to make an extra $2,300 just by doing subject to and by doing it the way we did it. So I hope this helps you. And if you have any questions, comment below or shoot me an email, and I'll catch you guys on the next one.
I'll see you when I see you.